Hello everyone, I am Anil on behalf of eDot Academy. I welcome you once again in our video. So today we have arrived at module B of BFM. So in this video we are going to start risk and basic risk management. That is unit 8 of BFM. And next chapter I will try to cover risk in banking business. So let us start. So what is risk management? Before we try to understand what is risk management, we have to understand actually what is the risk. So risk is possible due to unfavorable impact on net cash flow. Actually, what happens when we conduct one business, so there is always cash inflow and cash outflow. So that means difference of cash inflow and cash outflow is called net cash flow. So if something like unfavorable impact is there, what types impact will happen? That means there is always uncertainty associated with the happening of any event, because there might be some event which we did not think of but they are happening, and there must be non-happening of event means we are thinking something but they are happening something else. So due to that there is always unfavorable impact on net cash flow, so that becomes the risk. So for the mitigation of this, capital plays very important role, and it plays like a cushion or shock absorber required to absorb the potential losses in the future. Higher the risk, high will be the requirement of capital. This point is to be noted here. Very important point has come here. Higher the risk means if risk is higher, the requirement of capital will be more for running the business. Okay, and there will be rise in RAROC, that means risk adjusted return on capital. Okay, we'll discuss this point later on. RAROC means risk adjusted return on capital. Okay, so they dealing with, we'll discuss what many types of risk is here. So risk is basically divided into two parts. Number one is the transaction level and number two is the portfolio level. Okay, transaction level means credit risk, market risk, operational risk are considered as transaction level and managed at the unit level itself. That means CMO. We are dealing with CMO means credit risk, MO means market risk, and O here means operational level. So you have to differentiate first what is transaction level. Transaction level means whatever transaction we carried out. We carried out or in future will be carrying out, called as a transaction. And portfolio means when we acquire the asset, when we keep with us and for a long duration, that is called the portfolio level. You might have heard this word in the share market where these people they maintain their portfolio. Means they purchase 100 share of Reliance Capital, uh, uh, 2000 share of Tata Motors, like this, and they keep it for the future profit. Okay, so that becomes your portfolio level. But transaction level means when you transact something, that becomes the transaction level. So portfolio level is liquidity risk. Liquidity risk is there. Interest rate risk is there, and also transaction level risk, but managed at the portfolio level. Okay, so if we consider about the portfolio level, so here I want to make it clear that liquidity risk and interest risk are also considered as a part of transaction level, but they are also managed at the portfolio level. Okay, so portfolio level means you might have seen uh, the management at hand. It may be your journal office, your circle office, your HO office. So they manage this uh, risk mitigation at the portfolio level. Okay, so moving ahead, before that, what is the risk? So we have to measure the risk. Means you have to quantify the risk. Okay, quantify the risk means in the value. We have to measure the risk in the value, means what amount we are running loss, or in future how much loss is going to happen. So that is called the risk measurement. So here are the based on sensitivity and based on the volatility. That means there are two market value. Okay, so that means if the change in market value due to 1% change in interest rate. So we are going to discuss here what is the risk based on sensitivity. There are two factors are here on which base we can measure the risk in our business. That means based on sensitivity, number is the based on sensitivity and number two is the based on volatility. So based on sensitivity means if 1% change in the interest rate is there, like we talk about the bond pricing. Okay, if there is 1% increase in the interest rate, bond price will decrease. Further, if 1% increase in interest rate is there, bond price will further decrease. So this is called the based on sensitivity. That means in 1% how much change is happening. That is called the based on sensitivity. Like if we today the rate of interest is 10% and tomorrow it is becoming 11%. So there is change in 1% in interest rate. But what is the change in the bond pricing? We have to calculate the formula. So that is called based on sensitivity. So this is always taken on 1%. Keep in mind. Okay. So interest rate gap is sensitivity of interest rate margin of banking book. Okay. And duration is sensitivity of investment portfolio and trading book. Okay, that means whatever the sensitivity you can see where you can see the sensitivity. So this sensitivity we can see in the trading book. Okay, we'll discuss what is the trading book and investment portfolio. Okay, that means it will impact at two places. Number one, investment portfolio or trading book. And second one is called based on volatility. So volatility is nothing but standard deviation. We might have seen the formula of standard deviation. So I'll just write here the formula, just remind you. Standard deviation formula is nothing but square root of x minus x bar whole square divided by n. Okay. So n may be capital or small. That depends on the what you are taking. You are taking sample or you are taking the total population. Okay. Now, so this is called volatility. So just for reminder's sake, what is variance here? So if you remove the square root, it becomes variance. Okay. If you remove the square root, it is called variance. And you have to put sigma also. I have to add here just. So sigma means you have to add sigma x minus x bar whole square. Then it becomes variance. If you take square root of this, then it becomes standard deviation. So I'll reiterate once again what is the formula of standard deviation. Square root sigma x minus x bar whole square divided by n is called standard deviation. So volatility is nothing but it is common statistical measure of dispersion around the average of random variables such as earning, mark to market value, loss due to default, and statistically volatility is standard deviation of value of variables. So if you calculate the standard deviation, okay, so from that standard deviation, what is the variation? I just take example here, just show you what is the how to calculate the volatility. Like I am taking value 1, 2, 3, 4, and somehow you are getting a standard deviation. I just start taking hypothetical value. I don't think about the correct value. So 2.5 I am getting a standard deviation 2.5. Okay, so now what is the variation? That means 1 is how much varying? So 1.5 it is varying, minus 1.5. So it is going down from 2 minus 0.5, from 3 0.5, and from 4 1.5. So that means if it is negative, that means we are incurring loss. If it is positive, that means we are gaining something. Okay, so this is called volatility. Now I'll take one question here just to make it more clear. We have to find out volatility of a given stock price over a given period. Okay, volatility of given stock price over a given period. Volatility may be weekly or monthly basis. Okay, suppose just I am taking a hypothetical value. Suppose we want to calculate weekly volatility. We will note down the stock price of number of weeks. Okay, that means we'll take the number of weeks and then we take the stock. Let the mean price is this X bar. I told you na X bar. And the mean price X bar. Okay, and variance I told you X minus X bar whole square, take sigma and divide by n. So same here, sum of squared deviation from mean, sum of squared deviation, that means deviation x minus x bar squared square here and sum is 82.70. Okay, so variance is this. So what is standard deviation? So standard deviation is nothing but square root of variance. I told you, because when you take a put a square root, you will get the standard deviation of variance. So this is variance only. Okay, so take a square root 82.70, you will get 9.09. So this is called volatility. So how much volatility is there? 9.09. Now how to change this volatility? Like in the previous question, I have taken weekly basis. I just take for example of weekly basis. That means this volatility as the weekly basis. Let us suppose that I want to change this volatility on daily basis. Okay, so what is the formula? This will I just write the formula here. The formula is written here: volatility over a time horizon t equal to daily volatility into square root t. Okay, so as per this question, I will take a previous question only. 9.09 is the for weekly, so it's the weekly only, and this is the daily volatility, and this is a time horizon week. How many days has 7? So if you want to find out daily volatility, you just 9.09 divided by square root 7. So 9.09 divided by square root 7, you can convert into daily volatility. So I'll take one more example here. Example number 2 means if you want to find out from daily to weekly or daily to monthly. So same formula is here. Means volatility over time horizon t equal to daily volatility into square root t. Okay, now see the question here. So daily volatility is given 1.5%. So daily volatility is given 1.15%. Monthly volatility, yes, 1.5 square root 30. That means from daily to monthly, just we multiply square root 30. So find out the square root 30 means 5.48 multiply 1.5, so 8.22. So that means we can convert from daily to monthly, daily to weekly, daily to yearly, or monthly to yearly also. If you want to convert monthly to yearly, then you have to multiply square root 12. Okay, and one more point you have to keep in mind: if time horizon is increasing, that means your daily volatility will also increase because you are multiplying with the square root of that number. Okay, there is also one measurement is called downside potential. Okay, so downside potential is nothing but it is part of our volatility only. Okay, is part of volatility only. But what is the difference here? In volatility, we measure the variation both sides, means positive and negative, whereas downside potential we take only the negative values. Okay, that means like I took example here. Now I just show you here. That means when profit is there, we don't consider, and when loss is there, we take only that value only. So it captures, just see the definition here. It captures only possible losses, ignoring profit, and risk calculation is done keeping in view two components. Okay, potential loss and probability of occurrence. Okay, so we don't take positive value, we take only the negative value, and it is considered as a potential loss, and we also consider what is the probability of happening of that event. Okay, so this downside potential measure is more relied upon by banks, financial institution, RBI. Okay, And value at risk is a downside risk measure. Okay, so value at risk. So we give another name, that is value at risk is a downside risk measure. Now I'll see how risk pricing is done. So risk pricing is done based on the risk pricing. Risk pricing is done based on the risk premium. Okay, and premium is added in the interest rate because of the following. Okay, why we add the risk premium? Necessary capital is to be maintained as per regulatory requirement. Okay, from where we'll get the capital? Okay, so any banking company, they accumulate the capital from the risk premium because they charge some extra. Okay, and capital is raised with the cost. Okay, because there is always cost of the capital, because when you raise the capital you have to pay interest to somebody, that becomes the cost of the capital. Okay, I just take one example here, show you how the premium is added, how the so there are 100 loan accounts with level 2 risk. Okay, it means there can be average loss of 2% on such type of loan account. So risk premium 2% will be added to rate of interest. Let's say rate of interest is 10%. Okay, so we'll add 2% plus this. So basic rate is 10%. So what we'll do it, 10% plus 2% of 2% of 10. So 2% of 10. That means we'll get 10 plus 0.2. Means 10.2 will be the rate of interest. We have added the 2% as the premium. Okay. So this pricing also include, this pricing means whenever do the pricing, this pricing also include cost of deploying fund. Cost of means we have to keep into account how you are getting the fund, how you are managing the fund, because you must have borrowed from somewhere. You must be paying some interest. Let's say you be paying interest to the customer, those who have lended their money to you. So let me 6%. So that you have to keep in mind. Well, below you cannot give, you cannot give on credit. Like below this interest you cannot give to somebody. Okay, operating expenses, because bank is also operating. There are some expenditure is there. Okay, electricity charges, their rent is also, you have to keep in mind also. Loss probabilities. Okay, and based on the risk rating you have to judge what is the loss percentage and what is the capital charges. Okay, because bank is also maintaining some sort of capital for managing this credit. So you have to keep in mind the what is the capital rate also, that is called capital charges. Okay, so moving ahead, now we'll see unit 9, that is risk in banking business. So basic our focus is on the banking business here. So what type of bank is facing the risk? Now starting with there are many risks, but how to mitigate them? Mitigate means how to reduce the risk, because all business enterprises, they have one sort or other, always some risk is there. Okay, so we'll see one by one. Number one, the credit risk is a very popular risk. It can be mitigated by accepting collaterals. Like if one customer is taking some loan, so you can ask from the some collateral, maybe asset, maybe jewelry, maybe FD, maybe house, maybe whatever is there. So third party guarantee also there, and diversification of advances and credit derivatives. You can diversify your advances. That means instead of giving one customer, you can give to 100 customers or many customers, and credit derivatives. Okay, that means you can form your credit derivatives also. That means you can form a bunch of uh, credit derivatives. You can create your own bunch of facilities. And how to reduce the interest rate risk? So interest rate risk can be reduced uh, by derivative of interest rate swap. Swapping means changeover. Okay, swapping means changeover. And you might have seen that swapping in the this forex business and equity market also. And if some share is going down immediately, what they do, they sell that share immediately, so that or they switch over to some other share. It's called swapping. Okay. And forex risk can be reduced by entering into forward contract. है ना? We have already studied this forward contract and futures. है ना? So these are the derivatives. है ना? These are the derivative of the forex market, forex contract and future contract. है ना? If we make advance to different type of business with different risk percentage, overall risk will be reduced through the diversification of the portfolio. That means we should not uh, give our advances to only one type of business, because one business is failing, then nothing will happen. So we should always diversify different type of businesses, different type of customers, because if one type of business is failing, so other at least one will give you some profit with different risk percentage, and percentage may be also different. So this is called diversification of the fund, or you can say diversification of the portfolio. So this will reduce your risk up to some extent. Now moving ahead, there is also called banking book, trading book, and off balance sheet items. Okay, so banking book is nothing but all advances, deposits, borrowings which arise from commercial and retail banking. Keep in mind, banking book include is very important. Banking book includes all advances, deposits, and borrowings and arise from commercial and retail banking. So those who are working in bank, they must be knowing the advances, term deposit, fixed deposit, and this come under deposits and advances. Then you give housing loan, gold loan, agriculture loan, many loans are there, cow loans, goat loan, all agriculture. Okay, these are held till maturity and accrual system of accounting is applied. Means they are held till maturity, because we wait for the time to come. Like somebody has taken the loan for the 5 years, so we wait for the 5 years. It's not this next month we are going to sell it, or we are calling customer, okay, you pay the interest, and accounting is done on the accrual system. Accrual system means whenever the uh, liability is rises or loan is rises, we take into books of account. Okay, the risk involved are liquidity risk, interest rate risk, credit default risk, market rate, and operational risk. So these are the risks involved in the banking book. Okay, next come trading book. It includes assets which are traded in market. Assets which are traded in market. These are not held till maturity. That means we don't wait for them mature. As soon as we are getting the profit, we sell them immediately in the market. And positions are liquidated from time to time. That means we keep on selling and buying. Okay, and these are marked to market. That is difference between market price and books price are taken as a profit. Because if the price of something is going high, that means we are getting profit. Because if we are going to sell in the market, we'll get some profit. No, we get more rate of that. Whereas if you see the difference here, banking book. So banking book, we don't take mark to market, because we from there we get the same rate of interest either in deposits or in advances. Okay, if you advance, we take same rate of interest, and deposit same rate of interest until less a revision of interest is there. Okay, daily we don't revise the rate of interest, or we don't consider okay mark to market. So that means in the trading book, mark to market, the difference between market price and book value is taken as a profit. And trading book comprises of equity, foreign exchange, holding and commodities. Holding and commodities. So you can see what is the difference between trading book and banking book. Banking book is our day-to-day functioning of, you might have seen advances, deposits, borrowing, commercial banking. Whereas trading book is nothing but is holding of equity, commodities. है ना? These are called trading book. And trading book is always uh, taken as a mark to market. So this was the main difference between trading book and banking book. And trading book also include derivatives. Okay. And risk involved in market risk, however, credit risk and liquidity risk can also be there. Okay, no problem, because market risk is always there, you know, in the trading book. Credit risk will also be there. Then it's called off balance sheet exposure. You know? The off balance sheet exposure nothing but contingent liabilities. You know, that may be guarantees issued by the bank, LC issued by the bank, and other obligations. You know? Why these are off balance sheet exposure? Because these liabilities may arise in future depending upon the situation. है ना? If one customer is defaulting, then the guarantee will be invoked. Okay, it's include derivative also. These may be form part of trading book or banking book after they become fund-based exposure. Okay, when they become fund-based exposure, that means when liabilities arise in, then it become the part of the trading book or banking book depending upon the their nature. Okay, now we'll discuss the types of risk. So types of risk: liquidity risk is there, funding risk is there, time risk is there, call risk is there, gap mismatch risk is there, basis risk is there, yield curve risk is there, embedded option risk is there, reinvestment risk is there, market risk is there. So we'll see credit risk, default risk. We'll see one by one. Country risk is also there, operation risk is there, fraud risk is there, and transaction risk is there, compliance risk is there. Other risk is also there, strategic, reputation, systemic. Okay, so we'll see briefly one by one risk. Some of the risks are very confusing, so you have to pay attention because some they're common. Some of these are very common. Okay, so liquidity risk. It is an inability to obtain fund at reasonable rate for meeting cash flow obligation. Okay, so because it is inability to obtain fund at the reasonable rate to meeting the cash flow obligation. Liquidity risk is of the following. Now, what are the parts of this? Okay, funding, time, call. So, what about liquidity risk? Like in your bank, you do FD. Some customer come for the fixed deposit of 5 lakh rupees, and you have given the loan for 5 lakh rupees for 3 years. 3 years, and but a customer he has given the FD only for the 1 year. Then after 1 year, what will happen? This liquidity will arise. Okay, from where you will going to get the amount back to the customer. Okay, so funding risk is a part of liquidity risk only. It is risk of unanticipated withdrawal. Correct, I told you it is risk unanticipated withdrawal and non-renewal of FDs, which are raw material for fund based facilities. Okay, because you have given the uh, fund based facility to other customer based on the FDs in your bank, but some customer they have taken before premature withdrawal, it's called na, and they have not come for the renewal. है ना? Premature withdrawal or non-renewal, called funding risk. Time risk, it is the risk of non-receipt of expected inflow है ना, from loans in time due to high rate NPA, which will create liquidity crisis. Okay, because due to NPA, you are expecting to get some interest from the your advances, but you could not receive in time. In time, okay, time is involved here, so that is called time risk. Call risk, it is the risk of crystallization of contingent liability. It is the risk of crystallization of contingent liability. Okay, what are the contingent liability? Your LCs, your bank guarantee. Okay, these are contingent liability. Okay, if they are rising, they call call risk. And moving at what is interest rate risk? So interest rate risk is risk of loss due to adverse movement of interest rate. Okay, adverse movement of interest rate, because interest rate may keep on changing. You have given advances for the lower rate, and but the FD's rate is increasing due to market situation. Okay, then you will incur the loss. So we'll see one by one. So in the interest rate, there is one part is called gap or mismatch. And a gap or mismatch. So this is gap or mismatch is a risk of gap between maturities of assets and liabilities. Risk of gap between maturities of assets and liabilities. What are the assets? Long-term loan are funded by short-term deposits. Okay, so your long-term loans are the assets and your deposits are the liabilities, because you have taken the deposit, you become liability. So long-term loan means you have given the loan for the long term, but deposits are for the short term. So they become the gap. So after maturity of the deposits, these liability are get repriced. Okay, because after the maturity, the rate will change due to market situation, or new liability will come. So they will get repriced, and gap of interest rate between asset and liability may become the narrowed, thereby reduction in profit. So your profit will reduce. Whereas for the asset side, you are getting same rate of interest, but for the liability, rate of interest has changed. So the gap has become less. So your profit will reduce. And what is the basis risk? Change of interest rate on asset and liability may change in different magnitude, thus creating the variation in net interest income. I just take with the basis how this happen. So for example, I just take here for deposits. Let's say for deposits you are for loan. So for loan you are charging 10%, for deposit you are charging the 7%. That means there is gap of 3%. So 3% you are earning the profit. Okay, but now both are changing the rate of interest. Let's say this become 8%, and okay, but it has become only 10.5%. So what is gap here? So gap is only 2.5%. Okay, so this is called basis risk. That means different magnitudes. Both are changing, but magnitude is different. One has changed to 7 to 8, other has changed only 0.5. So that came the creating the interest rate variation. This is called the basis risk. So you will incur the loss. Yield curve risk. So we'll see here yield curve risk. Yield is internal rate of return on securities. Internal rate of return on securities. Higher interest rate scenario will reduce the yield. Okay, and therefore reduction in value of asset. Adverse movement of yield will certainly affect your net interest income. Okay, so this is like your bond pricing. Bond higher the interest rate, the value of the bond will decrease. Okay, same thing here. Yield is internal return. Higher interest rate scenario will reduce your yield. Okay, thereby reduction in value of asset. Yeah, next we'll say embedded option risk. Adverse movement of interest rate may result into prepayment of CC on a term deposit, and it may result into premature withdrawal of TD and RD. Okay, this will also result in reduce net interest income. This is also called embedded risk. So what is embedded here? Because if one customer is doing FD for 5 years and he's coming after 1 year, okay, he's coming 1 year, then that means you have to pay. But based on this, you have given loan to somebody else. Okay, so this become embedded option, because this is embedded. Customer has got the freedom to come here after 1 year, also after 3 months, also sometimes the customer they come to the bank. Okay, I want to withdraw my FD. So this is called embedded option risk. But based on that fund, you have given the loan. But for loan you cannot recall. Now you, if you have given the loan for 30 years for a housing loan, you cannot say no customer you just repay, because one customer had come up FD withdrawal. So this is called embedded option risk. Now next is the reinvestment risk. So what happened? It is uncertainty with regard to interest rate at future cash flow could be reinvested. है ना, future cash flow could be reinvested, because in the future if rate of interest is changing and you have some amount of, let's say, 10 crore, and you are uh, again reinvesting, okay, reinvesting like maturity, and future rate of interest is changing, okay, future rate of interest is changing, that means this is called reinvestment risk. Okay, same thing applicable for the FD also. If FD has matured after 5 years, 5 years, and in future rate of interest is changing. Okay, and similarly the bond price also changing, and offset sometimes you have to reinvest, and you see if in the reinvesting you are getting the less rate of interest, but FD they are getting higher rate of interest. So this is called the, because you are reinvesting the amount and you are getting the lesser price, your profit is getting reduced. So that is called reinvestment risk. So market risk, next coming, market risk is the risk of reduction of mark to market value, because what is the market risk? The rate of commodity is changing day to day basis. Okay, rate of many things is keep on changing, sometimes decrease, sometimes increase. So market risk is the risk of reduction is mark to market value of trading portfolio, that is equities, commodities, currencies, due to adverse market situation. Sometimes what happen, the equity of the one company goes down, equity of commodity sometimes go up. So this is called the market risk. But where is the risk? If it is going up, the rate of is going up, there's no, if we get profit. But if the rate is going down, then this is great concern. So we have to manage that. So market risk comprise of price risk occur when assets are sold before maturity. Okay, so market risk comprise of price risk occurs when assets are sold before maturity. Like market is comprised of price risk. So price risk occurs when the assets are sold before the maturity. Okay, and I gave the example also. No, bond price and yield are inversely related. Okay, so bond price and yield are inversely related. If bond price going up, rate of interest goes down. Okay, or rate of interest goes up, bond price will goes up. Vice versa. Bond price is high, rate of interest is low. Bond price is low, rate of interest is high. And internal rate of return also affect the price of instrument. This is also very helpful. Okay. Price of other commodities like gold are affected by market trend. Forex risk is also called the market risk. Forex market is also part market. We say market, so it's called the market price. So liquidity risk and settlement risk also present in the market. Sort we have done. Next come what is credit or default risk. We every day we face this risk. Our customer, they are not paying, the account has become NPA. Okay, so credit risk or default risk is the risk by default of a borrower to meet the commitment as per agreed terms and conditions. Okay, that means customer does not pay interest, principal, whatever is there as per due date, and whatever date has been decided as per agreed terms and conditions, customer does not pay. Okay, so these are of two types. Okay, there are two types risk are there. So counterparty risk and country risk. Okay, counterparty risk, these include non-performance of the borrower due to refusal or inability. Sometimes they refuse, sometimes they don't have money, sometimes they have money but don't pay, sometimes they don't have money but they are willing to pay. Okay, okay, country risk, when non-performance of borrower arise due to constraint or restriction imposed by the country. Because some of the country do they want to control their economic conditions, so they put some restrictions. Okay, like sometime now China, they impose, okay, I will not import sugar from India, because they want to control the market. Okay, so many conditions are there because country risk. Similarly, operation risk, we every day we face our system is shut down, system is not working properly, light is not there, So it is due to the operation. Operation risk is the risk of loss due to inadequate or failed internal procedure, है ना? Either due to people or and the system. The external factor like dacoity, flood, fire may be cause operation risk, है ना? So fraud risk, है ना? Communication risk, sometimes documentation, है ना? Regulatory risk, compliance risk, legal risk, or but excluded the strategic, but exclude the strategic and reputation risk. And we every day we carry out a transaction risk, है ना? Sometimes we commit the mistake. So risk arising from the fraud, failed business procedure, है ना? And inability to maintain business continuity, है ना? It's called transaction risk, है ना? Sometimes happen we are going to transfer amount to some other account, but instead of putting one, we are putting two at the place. So the amount is going to some other person. So it's called transaction risk, है ना? Sometimes deliberate transaction is there. This is called fraud, है ना? Compliance risk, failure to comply with the applicable laws, regulations, code of conduct may attract the penalty and compensation. Sometimes we don't follow the regulations given by RBI, है ना? We do okay, nothing will happen. Will not do this, है ना? Like nowadays the RBI is telling okay, CKYC, you do CKYC, but we are not doing CKYC. So it is coming like this. Okay, but sometimes what happen if RBI become strict, they will impose a penalty, है ना? Okay, you pay me 1 million rupees because you are not done the all 100% CKYC. So like this, है ना? So we have to follow the compliance also, whatever the regulations are issued by either RBI or government of India or our from top management. Okay, so in addition to that, some other risk is also there. Strategic risk. So adverse business decision, lack of responsiveness to business changes or strategy to achieve the business goal, because the market situation is keep on changing very fast. So we have to take a quick action as per the changing business scenario. Like you can see the example of I'll just example of which yeah, Nokia company. So Nokia company could not take right decision at the right time, so they failed. So like many companies, they could not take decision at the right time, so they have to fail. Okay, uh, so reputation risk is also there. Negative public opinion, decline to customer base, and litigations, है ना? Sometimes what happen, no, negative public opinion is there, है ना? You are not handling customers properly, then customer will talk in a negative sense. Decline to customer, every day you cannot say okay, I will not print possible, है ना? Come tomorrow. So this give a negative opinion to the customer. Okay, and litigations also, court cases or litigations also give the negative publicity. Systemic risk, single bank failure may cause collapse of whole banking system and result into large scale failure of the bank. So systemic risk is the risk which arise due to the chain. One chain is there, no? A, B, C, D. Because the B has taken advance from the A, C has taken advance from the B, and D has taken advance from the C, and or D has taken advance from the B also. So if they have taken advance from the A, है ना? Now if D is failing, then C will not. That means D is not paying, so C will fail. C will fail, then B will fail, and B will fail, then A will fail. So that means whole banking system will fail. This is called systemic risk. That means chain is there. Okay, this is also called ripple effect. So ripple effect means systemic risk. So they dependent on the each other. It's called systemic risk. Okay, so we can see the example of closure of Erste Bank in Germany. Okay, so this closure of Erste Bank in Germany 1974. It it was an eye opener for the entire banking system. Okay, so people started thinking about that. Okay, this systemic risk is very risky for the economy of the whole country. Okay, so we have discussed a lot about this risk factor. So with this we finish our video, and please stay tuned with me. I'll very soon we start our Basel, because based on this risk factor, Basel was started, Basel 1, Basel 2, and Basel 3. We'll discuss all this term, and we also discuss how CRR is calculated. We'll also discuss how to calculate the haircut. Okay, so please stay tuned with me. This is the only short notes we are revising here. If you have some doubts, you may contact your book. Please, your contact your book if you want to have any doubt is there. Thank you very much. Have a nice day.